Do they skip or not skip? That's the question now. The Fed's rate hike guessing game kicked into high gear yesterday. First, it was Mester saying, oh, yeah, non-voting. But Mester saying, I see no reason not to raise. And then both Federal Reserve Governor Philip Jefferson and Philadelphia Fed President Patrick Harker both almost said the same thing, like they were sent to do it almost, suggesting the central bank may consider skipping a June rate hike. For more, let's bring in Joe Lavorgna, former NEC chief economist, and he is now SMBC Nikko Securities America chief economist. Do you watch the show?
Which show?
This show.
Of course.
Is there any other?
Rhetorical question.
I was ranting yesterday, which far be it, I usually don't rant.
Not like you.
Yeah, but I was ranting that, okay, Mester says, I don't see any reason to stop hiking. Did they see any reason to start hiking at zero? Could they see the future then? No. Can they see the future? They always use rear view mirror. So if you don't know the effect yet of what you've already done, why would you make that statement? And I think these other two guys were watching me.
They probably
I have delusions.
Well,
I have delusions of grandeur. And then they came out
Austin's
and said...
been watching you.
Yeah, Austin does. Where are we now? We were at 60.
Sure.
We went up
from close to 70.
To 70 that they were going to hike.
Came back. Well,
now where are we?
Well, Jay Powell came out a few weeks ago and talked about, mentioned pause. And then Chris Waller, who's basically his right-hand man from everything I understand, came out and said, well, we might be hiking. So it's like, oh, wait a minute, the left and right hands aren't connected here. And then you've had a lot of different commentary. Joe, the reality is once they pause, the market's then going to assume they want to ease, which is the right conclusion the market will draw.
It's the right conclusion.
I love
it's
the right
conclusion.
Yeah, because
the
thing is,
think we're going to stop.
It's kind of like, well, I don't want to get into a drinking analogy. It's too early in the morning. But that one final sip puts you over the edge. And I think that's kind of the tightening. It's the straw that breaks the camel's back.
You get the whirlies and throw up? Or
well,
that's TMI. Okay.
Yeah, exactly. But the thing is they've raised rates a lot. They've been very restrictive. The yield curve is so massively inverted. Leading indicators are down 13 months in a row. Inflation's lagging. They're making a classic policy mistake. I think it was Michael Burry who had said that the Fed not trying to make the mistake of the 1970s is making the mistake the Fed made of the 1930s. I mean, look what's happening with all these regional banks, and that's because you could put money in money market accounts. So if they raise rates again, that's only going to exacerbate the problem. For them to go in July, if they skip June, the hurdle for hikes has got to be really, really high regardless of what they say. They're really going to start up again?
It's odd to me. So I can understand if the Fed goes, well, we don't want to trust the yield curve because whatever. But leading indicators are such a part of normal business. Like we're talking, why don't they talk more about that? Why don't they talk about how we have to...
Because it's too much groupthink. There's too much consensus. I mean, economists don't agree on anything. And look at the Supreme Court as an institution. It fights and debates all the time. Yeah. All of a sudden, you got 19 people that basically always agree, except for the one token dissenter. In the old days,
you mentioned Austin. We had Austin on, and some people said when he was on saying I agreed with the last hike, they said it looked like a hostage tape. They said he absolutely, who was it? Someone was on this. They said he absolutely, I think it was Paul Tudor Jones, said there's no doubt that Austin didn't want to go last time. Yeah, they all got to go for...
I don't know why we have to have consensus.
Thing.
Why can't we have debate? So that's part of it. But on the yield curve, Kelly, why is it the yield curve is not useful? Is not a useful gauge? It is when the curve right now is deeply inverted. How does that curve normalize? It only normalizes because the Fed cuts. 10-year note's not going to sell off here. Why would the 10-year note sell off here with inflation coming down and break-even inflation expectations around 2%? The Fed would have to take the funds rate, for 10-year yields to sell off, the funds rate would have to go to like 7 or 8%. It's not going to happen.
So we're at the terminal rate already then. We're above the terminal rate.
Well, here's the thing, Joe. I would say is you look back at 2019, the Fed funds rate couldn't even get to 2%, and the Fed had to cut. This economy, to me, is not as dynamic as it was in 2019. I'm sorry. I just don't believe it. So how the heck can we sustain 5% plus Fed funds?
And they themselves...
I think we're going to go under 2.
That research where they said R-star is still, who was it, the official just the other day, who said, the economy still has the same sort of low natural rate that it did prior to the pandemic, which would make exactly the point you're making.
You've got look at productivity. You've got very little GDP growth. In the last 5 quarters, gross domestic product's grown 1%. The income numbers actually show a decline. You've got high employment. That only confirms you've got terrible productivity numbers. You've got an aging population. Real rates are probably, this is where I do agree with Larry Summers, real rates are probably 0, if not negative, the real natural rate.
So if they keep going then, and I do in some ways understand when they say, well, but payrolls are still positive and inflation's still, okay, I kind of get that. Those are the facts. What are the facts going to look like 6-12 months out, do you think?
Whenever the recession happens, people will be surprised. And that may seem like it's obvious, but the same thing happened in 08. Because I remember in 08 thinking the economy was going to roll over. And in the second quarter, GDP was almost 2.5%, and we had the soft landing. And we were 6-7 months into a recession. We didn't know it. So the surprise will be whenever that month the employment number turns out to be a lot weaker than expected and the unemployment rate gaps up 3 or 4 tenths, the bond market will price 75% of the Fed easing like immediately. And by the way, the average Fed easing is about 400 basis points.